586 closed trades can still hide a broken process. In this FTMO challenge, the account finished up $326.89, but the real story was a $1,266.38 drawdown, worse results after losses, and expectancy that collapsed when trading got busy. This was a two-step FTMO challenge with a 10% target. The trader later said the account started as a secondary account and eventually became the only active one. That matters, because once the pressure rises, the record stops being about ideas and starts being about behavior. On the surface, the statistics were only slightly positive. Win rate was 54.79%. Average win was $14.05. Average loss was negative $15.79. Profit factor was 1.078. Expectancy was just $0.56 per trade. After costs and slippage, the edge was close to zero. And costs were not trivial. Cost drag alone was negative $135.38. The drawdown tells you more about the lived experience. The maximum close trade drawdown reached negative $1,266.38. The worst 5% of trades averaged negative $61.26. And the worst 10% of losses made up 41.81% of total loss. That is the usual shape of damage in trading. A small number of bad decisions dominate the sample. Two behavioral patterns stand out. First, more activity did not help. On lower activity days, expectancy was $2.10 per trade. On higher activity days, it fell to $0.09. On the 17 days with at least 10 trades, expectancy was negative $1.81 per trade, versus $2.55 on normal days. That is classic overtrading. The account did not improve because it traded more. It deteriorated. Second, the trade after a loss was materially worse than the trade after a win. The next trade averaged negative $2.68 after a loss, versus $3.28 after a win. There were 161 rapid post-loss re-entries, compared with 103 rapid post-win re-entries. Rapid re-entry happened after 61% of losses, but only 32.2% of wins. You cannot prove intent from the record alone, but the sequence is consistent with loss chasing or revenge trading. There was also evidence of overlapping same-direction exposure. The records show 50 overlapping same symbol, same direction entries. That could be averaging, planned scaling, or something in between. What matters is that exposure was often added rather than cleanly managed. The side split is important too. Buys made $1,154.39 with 3.36 expectancy and a 57.85% win rate. Sells lost $827.50 with negative 3.42 expectancy and a 50.42% win rate. That kind of asymmetry is not a footnote. It is a decision point. The strongest hour was hour 15. Hour 1 was weak. Thursday was the best weekday. Wednesday and Friday were negative. I would not turn that into superstition, but I would absolutely turn it into a review filter. The practical lesson is simple. Keep the loss unit fixed. Do not move the stop. Separate signal quality from activity level. Review what you do after a loss, because that is where this account weakened fastest. And treat overlapping entries as a risk event until a written plan proves otherwise. This account came close to the challenge threshold, then gave back a large part of the progress. That is what fragile edge looks like. The question is not whether the method can produce wins. The question is whether it can survive the trader's worst habits.